Thanks for coming to see me today. I appreciate making it onto your agenda today. My job is basically dealing with tax deferrals or tax-free settlement situations, and that now includes even buying and selling of properties, so that one does not have to deal with the capital gains taxes. So that's my whole little niche here. So let me dive in here. So I think I'm ready to share a screen. I know we don't have a whole lot of time. I could talk about this all day, every day, and I do. But I'm going to try to keep this short because I have a very short amount of time. So let me share the screen and jump into what I got to show you. Here we go. All right. I had some technical difficulties over the weekend. So we had to switch my monitors around, so I can't get this to go full screen without losing everything. So I'm just going to dive in with this and go with it as it is. So, all right. So basically, tax deferral in lawsuit settlements, your client will love you for this. So whether it be your client or a coworker or just people in your world somehow, neighbor or something, boy, are you going to look like a rock star if you can point out some really cool ways of saving tax that most people don't know exist. All right, so this is the kind of a list of cases, although it's not necessarily all inclusive, but these are the major ones. If you have somebody who's settling an employment case, except for lost wages, discrimination, false arrest, breach of contract, any kind of sexual cases, we're seeing molestations, we're seeing grooming cases of all things now. Punitive damages, we're seeing a bunch of that now after COVID had the courts clogged up and nothing was settling. Now there are a lot of angry jurors and they're awarding a lot of punitive damages. So if you know of anybody, any of your clients or your attorney clients, fraud cases, emotional distress, property disputes, environmental claims. I just got a call on those cases in New Mexico where I think it was FEMA who didn't do what they were supposed to do. So some sort of environmental claims, civil rights violations, whistleblower. And as I said, selling a property or business, you can use a variant of this product. But I throw it out there since I have your attention for a few minutes. I want to show an example of what I'm talking about here, just in a sheer numbers situation. So let's say that the person that you know, your client, is about to get a settlement of $1 million. Typically the attorney fees are about, 40%, 33 to 40%, but I'm just rolling it to 40%, which would be about 400,000. That would net 600 to your client, or so it used to be. But due to the tax law change in 2017, they can no longer, write those fees off, such that now they have to pay the tax obligation on the full $1 million. So really, for every $1 million of a non-physical injury case, they're going to walk with maybe 200,000. So you can see how this is so nasty. Okay. All right. And here is the Tax Cut and Jobs Act in 2017. Plaintiffs will be taxed on the gross amount unless it's a physical injury case, or it can be an employment case. Those, for some reason, got to keep the tax write-off. It is set to expire in 2026, but in the meantime, it's pretty ugly. So I have this layout here that talks about what happens in a cash settlement. Pretty basic stuff. What happens here is that there are two sides. There's the plaintiff and the defense. And what happens is eventually both sides agree that the defense has the obligation to pay the plaintiff for what happened. So here is what happens in this situation. The defense cuts a check to the attorney. The attorney takes out fees and costs, writes a check to the plaintiff for what's left. And as you all know, constructive receipt occurs when they take that money in. And that is when the taxation begins on the gains, or in a case that is taxable to begin with, it's all going to be taxable. So once they take constructive receipt, there it is. Okay, they can take it, they can invest it. Both sides of the lawsuit have full and final release, which is a big deal in the legal world. You all know, most of you know what constructive receipt means. actual receipt, they have control is what I like to say. They can tell somebody how to invest it, and they can get to it whenever they want it. But if they use what's called a non-qualified, and you have to unknow what you know about qualified and non-qualified. This is not referring to retirement funds being qualified versus just private investment accounts being qualified. This is completely different. Either it qualifies under section 104A2 or it doesn't. And so that's what we're talking about here. Qualified in this case means physical injury or wrongful death. Non-qualified is cases of without physical injury or wrongful death. So they fall into that list that I showed on the first page. What happens in this situation is if there's any cash that's happening, some people say, well, I've got a $500,000 settlement. I'll take $100,000 now, and I'll take $400,000 over time in a non-qualified structured settlement. So what happens there is that the defense has this obligation to pay the plaintiff. They fulfill that obligation by assigning it to an assignment company, which is a sister company of MetLife. It's MetLife Assignment Company. And then MetLife Assignment Company goes out and buys the annuity and holds it. And then the payments come in over time, where then each payment is looked at as settlement of the non-qualified case from 2024. So what's going on here is this mechanism right here is what most people don't know exists, is that they can assign the obligation, and then the assignment company buys and holds it, and then the annuity company, MetLife, actually makes those payments. So the deferral is in this process. So when these payments come in, so let's say they're getting, $25,000 a year. Well, they're going to get 1099 on just the $25,000 they took that year. The rest sits down here, tax deferred. Okay, so it's super duper slick. Okay, so what is happening here is, again, both sides agree the defense has the obligation. The plaintiff elects to do a portion of their settlement in a structured settlement. The defense fulfills their obligation by assigning the obligation to the assignment company. They must be involved in this process, which involves signing all of the relevant settlement documents. The defense issues the check to the assignment company, and then the assignment company goes out and buys the annuity. The assignment company accepts the obligation to make the future payments. The assignment company then purchases and owns the structured settlement annuity that will make future payments to the plaintiff. Again, both sides get full and final release. All right. Now, these are annuities, but as you can probably imagine, these are not the ones you go buy from Joe Financial Planner down the street. They are absolutely not. They're not your standard retail retirement annuity at all. We have special training on this, special appointments for this. It is just, again, it is not something that just any financial person can do. They could actually mess it up pretty terribly. No annuity carriers are rated lower than an A, and actually MetLife is currently the only one who is doing this, and they are rated A+. They must be funded by the defense carrier, cannot be purchased by the plaintiff, because look, let's go back to this one, because if the plaintiff goes and does it, then they already have the money, right? If they have the money, they have constructive receipt, and all bets are off. So you have to kind of peel back the layers here and say, oh, so that is why these guys have to do it. So it kind of goes around about to the plaintiff. All right. And that is absolutely critical in the process. Okay. So must be purchased by the defense carrier. Every once in a while, you will have a self-insured, and there won't be an insurance company involved, but usually there's an insurance company that's doing this. Or you might have a big employer, some big company. I don't want to throw anything out there to throw anybody under the bus, but some big company, ABC, company that's a bajillion dollar, blue chip company. And then sometimes they would fund it themselves. All right. But there must be an obligation for party A to pay party B. So back to this diagram. There has to be this obligation. I have it in red here so that you can see that this is the critical part here. Okay. There has to be the obligation. Okay. So there needs to be a lawsuit or the potential for a lawsuit. And I use that example of potential for a lawsuit. Think about how quickly, if somebody found out that something happened and it went viral, right, on the internet, then everybody's going to find out about it and how terrible it was. And so a lot of times you'll see cases settle very quickly because they don't want it to get out, right? A perfect example of that was back, I think it was a little before COVID, there was a gentleman on a famous airline who was sitting in one of the seats and they dragged him off. He refused to give up his seat or something. They dragged him off and beat him up, broke his teeth out, hit the news big time. That thing settled within hours. And yeah, there was no time to file a lawsuit, but there sure as heck could have been. And that airline knew that. And so they said, we need to shut this one up. All right. So let me give you an example of what this looks like, because I'm a very visual person and I think it's helpful for people to see this. So let's say Michelle here is your client, and we already saw, back here, very front page, right? We see if she's got $1 million, wow, she's only going to walk with 200,000 of that, right? So I used $1 million just so you could see kind of what it would look like. For example, if she structured the whole million, which really isn't practical because they have to pay the attorney and all that stuff, but just so that you can see what it looks like. This could go for life, by the way. Let's break that tax consequence down and pay it over the rest of our lives. I assume that Michelle's about 50. So, and that matters, the gender matters because this is an annuity. So the gender matters, date of birth matters. So anyway, she would, if she had $1 million, what she could get for this would be, for example, $43.56 and 66 cents. I built this yesterday, so it's really fresh. Paid monthly for the rest of her life, beginning in January, guaranteed for 30 years. Payments would continue through December of 2054, or as long as Michelle is living, whichever is longer. So what happens here is, if you do the math on this, 43.56 times 12 months times 30 years, she would be getting $1,568,000 on that. And what happens for taxation purposes is she gets 1099 on the 43.5666 times 12, which I should have figured that out for you, 43.56.66 times 12 times. So she will get 1099 on $52,000 in actually, since this starts in 2025, she would get 1099 for $52,000 in 2026 rather than the $1 million. So you can see how this could be appealing to people. And so, like I said, if you do the math, 43.56 times 12 months times 30 years equals $1,568,000. This middle number, if she lives her normal life expectancy, which is 32 years, she will continue getting paid, and that could pay out 1.672 or more. If she keeps living, this has to keep paying her. All right, so the above benefits are taxable in the year they are received. Okay, a 1099 is generated that year. All right, so that's an example of what that could look like. Here's one using the same $1 million. So let's say she's got some monthly income here, but let's say I'm terrible at saving money. I would like a chunk of money that's going to come in right in time to pay my taxes. So here's an annual payment of $25,000 paid April 1st of every year, and a monthly income. Both of these go for the rest of this person's life. Okay, so you could see how this might really appeal to somebody that, well, I'm going to get a 1099, for in the first year, 2351. And then since this one starts the following year, then they would get 1099 the following year for one payment of 25,000 plus 2,300 times 12. Okay, so it breaks that down into manageable chunks over long periods. It doesn't have to be a long period. As a matter of fact, some attorneys or some accountants who do know about this, when it's presented to their client, brings it back and says, we want this all paid out in 5 years. Okay, we can do that too. Break it down into a shorter period than longer. All right. And then just one short little thing. What if we didn't want to go for life? Here's an example. We just did it for 30 years. Then you can see that they're making 1.7. So they're making 700,000 in gains, when all they're going to get taxed on in 2026 is about 60,000. Okay. So that is just a cool tool that when I talk to accountants or they figure this out, because somehow, you know, they, their client ends up getting one of these, accountants kind of really get excited about this. Okay. Rules of a structured settlement. Once they're locked in, they cannot be changed for any reason. So once they're locked in, they're locked in. And annuities, that's just a common trait of an annuity. It is a contract, so it's not easy to change a contract. If you bought a house next week, you know, and then 6 months later you said, oh yeah, you were supposed to build me a pool. Yeah, no, the contract is done, right? It's a done deal. You can't go back and change it. It is not impacted by the fluctuations of the stock market over time. Terms of the structured settlement are memorialized in the settlement agreement documents. All right, that is important. They have to be in there because the defense, it's going to show how they have paid what they paid so that they get their full and final release. They don't want to be tied to this anymore, any more than the person who is suing wants to be tied to them anymore. Also, the plaintiff/annuitant does not own their structure. If the plaintiff doesn't own it, it is very difficult to take from them in situations of divorce, bankruptcy, and general liability. All right. So if you go back to this right here, here's the plaintiff. Everything in this bubble is controlled by the plaintiff, right? This is my bank account. This is my Ferrari or whatever, my Rolex. But if the annuity is sitting down here, yeah, no, it's just like a pension. You know, you can't steal somebody's pension, or you can't sue somebody to get their pension. Or you could, but you're not going to be successful. All right. So if you don't own it, it can't be taken from them. All right. All right. Let's see. Non-qualified structured settlements are used in numerous kinds of settlements where neither a physical injury or a wrongful death occurred. So that's a pretty big list of case types, really, if you think about it. Again, obligation must be established. So if you were to call me, one of the first things when I ask you, tell me about the obligation. Tell me why this person owes this person money. Okay. Obligation is, I can't do anything in my firm without an obligation, other than we do some retail annuities. But any of the main stuff I do in my firm, it's all based on an obligation. All right. And it could be a friendly suit, by the way. Keep that in mind. All right. And here is the tricky part about this, is that the defense must agree to cooperate and participate, which means they must sign the relevant documents. So this is something that I have found in my 25 years of doing this job, is that sometimes if your client has an attorney and your client is telling their attorney, you got to tell the other side about this, those attorneys tend to say, oh, I want to use it as a, you know, negotiating strategy or something. When they do that, it never works. Never, not once will that work. You do not want to surprise the defense with something like this after the settlement is agreed upon. Okay, because they have to do it. If you look back to this right here, it's my obligation. I can do with it what I want. It's my party. I can cry if I want, right? It's my obligation. I don't have to write a check to MetLife if I don't want to, right? So you kind of have to lay that groundwork early on. Okay. All right. Why doesn't the plaintiff have constructive receipt? Well, because they don't take actual receipt or control of the funds. The assignment company assumes the obligation, and the annuitant's only right to that money is to sit back and collect it like a pension. All right. They don't have any kind of input on a day-to-day basis of what's going on in there. They can't call their, you know, like their, you know, Vanguard account. Hey, wire me some money because I just need to do something. No, you cannot do it. It's locked. It's put away. All right. Okay. So structured settlement requirements. Again, very precise language. This is IRS, stuff we're talking about here. It has to be correct. This is why you do not just call some financial planner with this. They don't know what these are. They have no idea. They may say, oh, it's a regular old annuity. I can do that. Yeah, no, they cannot. They absolutely cannot. And I have had to fix messes that other financial people have thought they could do this. They cannot. All right, non-qualified assignment and release must be signed in addition to any kind of settlement agreement that's taking place in the case. Again, defense must fund. Okay. And again, do not fail to bring this up during negotiations as early as possible. What's in, and I know I'm running out of time. What's in it for the plaintiff? Tax deferral, tax deferral, tax deferral, which is never going to be sexy. It's all about the tax deferral. And I'm going to just dive through this. What's in it for the defense? They just want their full and final release. I want out of here. They get to take their write-off in that current year, and they don't have to interact with the plaintiff anymore. Lastly, these are only offered currently through MetLife. These used to be offered through John Hancock, Liberty Life, but in the structured settlement arena, things change from time to time. So this is who we have it through now. And that is it. That is my very condensed, I'm out of breath version, 30-minute version of how I can help your clients defer taxes on a settlement. Any questions?
Looks like in the chat, Russ asked, why would the defense participate in this? And then I certainly see the advantage for the plaintiff, but not really for the defense.
Okay, fair enough. And that is a long story in and of itself, but you could basically, in theory, that's actually where they came from. The defense used to use these in physical injury settings to save money in settling a claim. So if you have a client who's looking at that $1 million, I'm going to clear 200,000 of every million, that gives you some negotiating room from the defense perspective to say, okay, we'll do this instead. We'll settle this for $950 instead. It could work. It did work for years and years before there were actually people who worked on the plaintiff side like I do. So potential money savings would be your answer, Russ. So yeah, if you ever have questions, you can always call me if you think you might need me.
Yeah, I think Kelly's, it's one of those things like, oh, I'll never need that. And then next week you'll be like, something will happen. You'll be like, oh, I know exactly who to tell you about. So
yeah, it's one of those things, that just workers' comp cases, those are physical injury. They do regular old structured settlements, tax-free ones all the time for those. So yes. Anything else?
all right. Thanks, Kelly. We'll chat soon.